Look, nobody stares at a crisp $100 bill and thinks, wow, this right here is going to completely change my life, right? Especially nowadays, $100 barely gets you out of the grocery store. It feels like pocket change in the grand scheme of things, just not enough to actually move the needle. But I am here to tell you right now, that exact mindset is why so many people miss out. That single $100 bill holds a hidden potential that is absolutely staggering. And honestly, that is exactly why the strategy we're looking at today works so beautifully.
To really wrap our heads around this, I want you to meet John. John's just our everyman. He doesn't have a massive pile of cash sitting in a bank vault somewhere, and he definitely doesn't have a fancy finance degree. But what John does have is an extra $100 a month. We're talking about the equivalent of, what, a monthly phone bill, a couple of takeout orders you barely even remember eating, or maybe a pair of shoes that'll end up pushed to the back of the closet in 6 months anyway. Well, John realizes he needs to actually do something with this money, besides just spending it. So the question we're answering today isn't whether $100 is enough to get started. The real question is, what actually happens when John stops spending it and starts redirecting it somewhere that grows?
Welcome to this explainer, the $100 wealth engine, demystifying the magic of investing. Today we're going to break down exactly how small, super consistent contributions can generate massive, literally life-altering passive income over time. We're going to build the ultimate wealth engine right in front of you, using nothing but cold, hard math to show you exactly how this whole thing works.
Okay, so the very first hurdle that trips everyone up is just figuring out where to put that money. When John hears the word investing, he immediately pictures stress. He pictures picking individual stocks, desperately trying to find the next Tesla, staring at flashing red and green charts all day long. But that is not what this is at all. An ETF, or an exchange-traded fund, is basically just a single purchase that buys you a tiny piece of hundreds of companies all at once. It's like a giant variety pack. Instead of guessing which single company is going to win, John just buys the whole basket. If one company has a terrible year, the others step up and carry the weight. He's not sitting there reading quarterly earnings reports. He just buys this one fund once a month, and the basket does all the heavy lifting for him. It's incredibly simple, and honestly, that's exactly why he can stick with it.
Section 1. The compounding machine. How money makes its own money. Now, before John actually picks his specific fund, we need to set up the mental model for this entire explainer. It's called compounding, and let me tell you, it is the absolute secret sauce to building wealth.
Let's just walk through how this concept works in miniature. Imagine you invest your $100 just one time into a stock that's trading at $5 a share. Boom, that gets you 20 shares. Now let's say that stock pays a $5 dividend yield for the year. That's cash paid out to you just for holding it. But here's the trick. You don't spend that $5. Instead, you automatically use it to buy one more share. So heading into year 2, you now own 21 shares, right? Well, your next dividend isn't based on your original $100 anymore. It's based on your new total. So in step 3, it pays you $5.25. That buys you another share plus a little fraction of one. Your money literally just made its own money, and then that new money turned around and started making even more money. And remember, in this little vacuum example, you never added a single extra dollar after that first 100.
But what happens when we add a few massive accelerators to this engine? That previous example assumed the share price just stayed completely flat at $5. It assumed zero actual growth. First off, in the real world, the share price actually grows over time. Second, John isn't just investing once, he's tossing in a fresh $100 every single month like clockwork. And third, he lets this run for decades. Every new $100 bill joins a machine that's already running at full speed. By the time his 50th $100 contribution hits the account, his first one has already been compounding and growing for over 4 years.
Section 2. The S&P 500 Strategy. Betting on America's biggest winners. All right, so where does John actually put this money to take advantage of this crazy machine? Let's take a look at the most common and arguably the most powerful starting point in the entire investing world. For literally millions of investors, the answer is an S&P 500 index fund, specifically the Vanguard S&P 500 ETF, which goes by the ticker symbol VOO. It tracks the 500 largest companies in America. We're talking Apple, Microsoft, Amazon, all stuffed into one single fund. John doesn't have to pick the winner because he literally owns a piece of the entire American economy. Plus, the expense ratio on this thing is 0.03%. To put that into perspective, for every $10,000 John invests, Vanguard charges him just $3 a year in fees. That is practically free. But the real magic here is the historical growth. We're looking at an average annual share price appreciation of 12.7%. That massive growth rate is going to do some serious heavy lifting for John.
Let's look at the actual projections here. In year 1, John quietly puts in his $1,200. Okay, nothing crazy, it just sets the stage. But fast forward to year 10. Over a decade, John has chipped in a total of $12,000 of his own hard-earned cash. Yet his account? It's grown to $22,660. So the absolute crucial point here is that the fund has added over 10 grand entirely on its own. John basically doubled his money without doubling his effort. That right there is what 10 years of boring, brilliant consistency looks like.
But John doesn't stop at 10 years. I mean, it's fully automatic now. He barely even notices that $100 leaving his checking account every month. By year 20, he's contributed 24 grand out of pocket. But he's sitting on nearly $100,000. And then we hit the awe-inspiring year 30. At this 30-year mark, John's total out-of-pocket contributions are just $36,000. Yet, his account has absolutely exploded to $358,324. Think about that. The fund has generated roughly $322,000 that John never had to clock into a job to earn. The wealth engine is fully operational.
Section 3. The dividend twist. The shocking truth at year 30. Now you might be thinking, the story ends right here, with John sailing off into a wealthy, stress-free sunset. But there is a massive twist to this strategy that most people just don't see coming until it's way too late. Let's take a look at the actual passive income this massive account is producing.
John logs into his account to see how much this huge $358,000 golden goose is actually paying him in monthly cash dividends. The answer? $41. Yeah. Take a second to really process that. On a portfolio worth well over $250,000, the Vanguard S&P 500 ETF is only handing John $41 a month. No way, right?
The harsh reality here is that the account grew, but the income did not. Now, I want to be incredibly clear about something. This tiny dividend payout is absolutely not a flaw or a glitch in VOO. It's actually doing exactly what it was designed to do. VOO is built for massive growth, pushing that share price as high as humanly possible. It is just not built to hand you a monthly paycheck.
Section 4. Growth versus income. Introducing the dividend champion. So, John's got a bit of a problem. He has serious wealth on paper, but no real income to actually live on. We need to introduce a second fund designed to solve this exact problem.
Enter the Schwab U.S. Dividend Equity ETF, or SCHD for short. This fund operates on an entirely different philosophy. It doesn't even try to compete with VOO on raw share price growth. Instead, it holds around 100 companies selected specifically for paying out consistent dividends and, more importantly, growing those dividends year after year. SCHD boasts a dividend yield of 3.41%. Guys, that is 3 times higher than VOO. And its dividend growth rate is nearly double. Now, the trade-off here, its share price appreciation is about 4 percentage points lower than VOO. SCHD's entire game plan is using that massive dividend compounding to grow your account, paying you substantial, tangible cash while it does it.
So what actually happens when we run John's exact same scenario, $100 a month, the exact same discipline, but inside SCHD instead? Well, for the first 20 years, SCHD actually loses the race. VOO builds a noticeably bigger total account value, but wait for it. By year 30, SCHD doesn't just catch up, it overtakes VOO. The sheer compounding avalanche of those reinvested higher dividends eventually pushes SCHD to $374,764. It literally spent 2 decades losing just to surge past and win at the finish line. But honestly, the total account value isn't even the most shocking part of this. We already established that VOO pays John a measly $41 a month, but SCHD? It generates $18,898 a year in cash dividends. That breaks down to $1,575 every single month. John is getting paid more in a single month of purely passive income than some people earn working a full-time job in a week. And remember, it all came from that exact same original $100 a month.
So what is the ultimate takeaway from all this? Neither fund is wrong, they just serve 2 entirely different investor identities. VOO is the quintessential growth strategy. It's for the investor who wants to build a massive pile of wealth over time and plans to slowly sell off those shares later in life for cash. SCHD, on the other hand, is the ultimate income strategy. It's for the investor who wants to build an account that acts like a literal money-printing machine, paying them substantial cash without ever having to sell a single share. Same $100, same 30 years. Two radically different outcomes based purely on the strategy you choose.
And that brings us to the most important question of this entire explainer. Now that you've seen the math behind the curtain, now that you know the hidden power of a single, seemingly insignificant $100 bill, which path makes sense for you? Are you chasing the massive peak of a growth strategy, or are you building the unending cash flow of the income strategy? The machine is sitting right there, waiting. You just have to decide how you want to build it.